The 1031 exchange is pretty straightforward, right? You have to follow certain timelines, certain restrictions, but so long as you do that, you can continue to use this strategy. And what we call it is, swap till you drop. You can just keep using this strategy because the downside of selling, right, are the tax exposure.
Welcome to the Real Freedom Show, where we inspire you to pursue your passion to gain time and financial freedom through opportunities in real estate. I'm your host, Mike Swenson. Let's get some real freedom together. Hello, everybody. Welcome to another episode of Real Freedom, Real Estate Leverage Freedom, where we talk about ways that people can build time and financial freedom through opportunities in real estate. I'm your host, Mike Swenson. If you want to get started on your real estate investing journey, check out our website, freedomthroughrealestate.com. It's where we put all of our content for you to check out, research, and figure out what's going to be the best spot for you in real estate, where you want to go, or what you need to learn. Today, I'm so excited to share we have a wide variety of topics that we talk about and educate people on. And today, we're going to be talking a lot about 1031 exchanges and Delaware Statutory Trusts, conversations that come up a lot. There's not a lot of people that probably know this in depth at a level that they need to. So today's guest, we've got Ashley Romiti. She is the founder and president of GCA 1031, educating investors on how to navigate investment property sales, taxes, and long-term planning through 1031 exchanges and Delaware Statutory Trusts. And so this is a great episode for you guys to learn and understand and kind of figure out strategy-wise, maybe some great moves that you need to make. So Ashley, we're so excited to have you on the show.
Thank you for the introduction. So Ashley Romiti, I guess before I get into it, I do like to tell a little bit of a story about how I got into this industry, because by no means did I plan to become a real estate expert or work with real estate investors. I actually started my career wanting to be a neurosurgeon. This was 20 years ago. I wanted to be in medicine. And I always tell people this because, you're talking to young investors, young professionals who are saying, oh, this is what I want to do. And I think what my story shares is that life is not linear. It throws curveballs and you never know where you're going to end up. I grew up thinking you were going to be a doctor, a lawyer, go to grad school, do all this. And just through my experience, I fell into the real estate industry. Realistically, I was pitched, I was told, I was doing school, I was studying, and someone said, you get into real estate, you have a lot more freedom. You can, at that point, I was like, 20 years old. They said, oh, you can go get lunch whenever you want. You can, go make your own decisions. And that was very attractive to me, was having that freedom. It was something that I had never really thought about for my career. And today I am so glad that I followed that, because now I have my daughter. I get to show up for school. I get to do drop off and pick up. And I have this flexibility from being an entrepreneur and owning my own firm to be able to go out and not only focus on the work that I love, but also do the real life stuff, which is why I go to work in the first place. And as for real estate, so I started back in maybe 2013, 2012 at a firm, Marcus and Millichap.
Mm-hmm.
Probably heard of them.
Mm-hmm.
Maybe you've worked with them, Mike. I don't know.
Mm-hmm. Yep.
Um, and I started working trying to represent retail owners here in South Orange County. I was in my early mid 20s. I didn't know much. I looked really young, and I'd go in these meetings with these savvy, sophisticated investors. And I remember being in one meeting, and someone looked me at the senior I was with and said, "Why'd you bring a high school intern?" And so I went to the team and I said, I have to figure something out. Like, I'm not being taken seriously. I'm in my early 20s. I look young. And so we came up with a strategy where I was going to work with 1031 investors. It was right after the 2008, 2009 recession. Single tenant triple net properties were becoming more popular as, right, baby boomers slowly started to retire. And so what we re-strategized was I would work nationally with these single tenant property owners doing cold calls, doing everything over the phone. It was, I need to speak before anyone saw me. And I laugh at that story because, again, I never would have planned for that. It just was circumstances put me in a situation where I had to get a little bit more creative. And that is how I started working with 1031 exchange investors was, I'm based in Southern California. I was working out of the Newport Beach office. And so I would work with, helping the local investors reposition their equity and move out of state into these single tenant triple net properties. And for the triple net owners, and for those who don't know what triple net is, it's a lease structure where the tenant holds all the responsibility. The landlord does not have that responsibility. And so they're a great passive strategy. And um, and so a lot of those owners that I had worked with, they had bought their deals at 7, 8, 9 caps. And now we were going out and we were evaluating them at 4, 5 caps. So they were repositioning their equity. So it was a really good time to kind of step into that space. And since then, I've just really narrowed down on how I work with investors. For me, the what drives me are the clients that I work with, right?
Mhm.
I work very much with your savvy, or not even always savvy, your real estate investors who have been in the industry for a while. They've owned their real estate and they're looking to reposition their portfolios into a passive strategy. Um, and even more so today, right? It's harder to find deals. I mean, you've probably shared about it on your podcast when we talked briefly on finding good deals today. It's very hard. Interest rates are a little bit higher than, what we were used to a few years back. And so I'm even seeing younger individuals come into these what we would call alternative investments, specifically the Delaware Statutory Trusts or even other types of private placements where you can come in, you invest, with much larger companies. You're becoming in as a fractional owner. You don't have any voting rights, but you have this very strong team who's doing your acquisitions, who's doing your underwriting. And so, yeah, so the group that I've been working with are those retiring investors, but I am seeing people coming in younger to these deals. I'm also seeing that people are retiring earlier, right? So it's been a very cool experience to work with this population and continue to see them grow. But that's a little bit about me.
I was gonna say first, when you talked about looking young, that was before the days where we had all the filters, right? You could have like been on some calls and had some aging filters so you didn't look
Yeah.
so young on your calls. So you were just a person before your time in technology. So, but yeah, I mean, to your point, I've had the opportunity to work with investors of various types, and some of them really want to be hands-on. I will say probably some of them starting out like the idea of wanting to be hands-on, and then they realize, shoot, this is way tougher than I thought it is. Or they do have some success and they try to do it on their own, and as they scale it turns into a full-time job, a second job, because they're working whatever their day job is, and they're building their portfolio, and it's just draining them because they're dealing with calls from tenants on nights and weekends, and they're trying to get out of it. I remember talking with somebody looking to do a syndication, and they had 8 or 10 units, not a huge portfolio, but they're like, I would love to just get out of this because I spend so much time doing it.
Yeah.
And so I think over time, I mean, I think there's value to, figuring things out where you're at and learning, but there's also value to kind of pushing the easy button. If you don't have to do it and you don't want to do it, there's lots of ways to be passive. And then that's kind of what we do in our space with, our apartment buildings is passive. But yeah, to your point, like there's opportunities where you don't have to do the grind. You might think that it's a badge of honor, or it's something you have to do to be a real estate investor, but you absolutely don't have to do that stuff. So just kind of my personal take of the experience, the investors or wannabe investors that I've worked with, like, yeah, there's people that just get burnt out doing this stuff and it's pulling them away from what they want to do in their life. And so team up to you, right? The people that just want to go live life and you can help them with everything else.
Yeah, it's funny. And everyone always asks, they assume that I'm a big real estate investor and I own my own properties. And I tell people after working with landlords for nearly 15 years, I prefer a passive strategy. right? I am not looking. I hear the horror stories of, we call it getting out of the three T's, the tenants, toilets, and trash.
Hmm.
Um, and just, owning real estate is, like you said, it takes time. It's another part or full-time job, depending on the number of doors or the quality of the asset. And so I'll kind of dive right into DSTs. What they are designed for are for those who want the passive income. I will say most of the time the clients who invest are older. You don't have to be, but the structure of the DST makes it so that it's more appealing to those investors who are looking for capital preservation and income. There's a little bit of appreciation if the real estate is structured that way. But, when you're looking at your broader portfolio and you're saying, you want to diversify, maybe allocate some to growth, some to income, some to capital preservation, this is going to fall more into those latter categories. And then before I dive in, I do want to share these types of investments are, you do have to be an accredited investor to invest. So, what accredited investor is, for those who don't know, either you meet a certain income requirement or a net worth requirement. And so, everything I'm speaking about requires that all the investors I work with show proof. So, Delaware Statutory Trust, it is a trust that owns a piece of real estate. So, if you think about, you might own real estate in your family trust or in your LLC, it's the same concept, but what makes it very different compared to when you invest in other types of entities or other types of syndications is that DSTs are 1031 eligible. So, a 1031 exchange is a tax deferred exchange where you can buy and sell real estate here within the United States, and you do it all tax deferred. It's IRC code 1031, and what it says is you can buy and sell real estate that are investment properties, and they must be like kind. But it's a great strategy then for investors to not only build their wealth on the front end, but also to preserve it on the back end. So, for just a quick example, here locally, we'll see a lot of investors start with maybe a single family home or a duplex. They buy it, they build up a little bit of equity. Now they want to move into four units. Well, now they can sell that real estate and go using a 1031 exchange, go buy that four unit, and they can slowly build their portfolio in that manner. And the 1031 exchange is pretty straightforward, right? You have to follow certain timelines, certain restrictions, but so long as you do that, you can continue to use this strategy. And what we call it is, swap till you drop. You can just keep using this strategy because the downside of selling, right, are the tax exposure. If you've owned a real estate asset and it's appreciated, you're going to owe capital gains on a state and federal level. Right? I'm in California. We're upwards of 13% on capital gains for the highest earners. You owe depreciation recapture. And so when investors go to sell, all that equity that they've built can easily be lost paying taxes. So that's what the 1031 is for. And historically, or typically, when investors think about it, they think about buying and selling these direct units, these direct assets. But what about those who want to be 100% hands off? Well, the typical syndications, like I was referencing, or entity ownership, don't always qualify for the exchange. And so the Delaware Statutory Trust in 2004 was made eligible for this tax deferred exchange, and it's become more popular probably after 2010. Prior to that, there's a structure called tenant in common TICs, which were more favorable, but those really went upside down in the 2008 2009 recession. And so a lot of these sponsors have moved to this DST structure. And what the DST structure does, it's a large firm, they're called sponsors. They go out, they'll buy a piece of real estate. Maybe it'll be a, 50 million dollar property in Atlanta, Georgia. They'll go out, they'll buy it, they'll put it into this trust structure, and then they'll go out to the retail market and they will raise capital through advisors like myself or traditional financial advisors. A lot of sponsors are doing it in-house as well. But now they're going to go out, they'll raise $50 million, And all investors who come in are fractional owners. What that means is that they're going to get the same benefits as owning their direct real estate without the hassle of getting calls at night from tenants or getting calls that the toilet is leaking, right? These are structured where an investor can come in and invest as little as $100,000. That's the minimum on these.
Hmm.
Most of them, not all, but most, and get a monthly paycheck, right? And they're going to own a, they can visit, right? They're going to own a piece of this real estate. They're going to benefit from the depreciation of that real estate. When it sells, they're going to benefit from the appreciation. So, you get very similar benefits as being the direct owner, but you don't have to deal with the hassle. And today, I was reading this morning, right? We're going to see 17 to 19 trillion dollars in transfer of wealth from the baby boomers. That report said that they owned 40 to 50% of the real estate within the United States. And so where they're looking to place their capital is they're looking for these passive solutions. Um, a lot of the kids, the beneficiaries, aren't wanting to do the hands-on. You might see that as well with, with your syndications, having those
Hmm.
younger investors come in because they're not quite ready or they don't want to be hands-on.
Yeah, for sure.
And and yeah, so that's what the DST permits investors to do. It allows them to come in, get that fractional ownership, collect the monthly income, and not have to worry about getting any of those calls. Um, it is a different life cycle though than when you go into buying direct or you go into a syndication, maybe with friends or someone local, you're investing today and you're invested typically for 5 to 7 years. And these are illiquid investments. So it's very important to, I mean, this is true with any deal you go into, though. You want to do a strong due diligence on the upfront and understand the metrics of the real estate you're buying to make sure that number one, the underwriting makes sense. And then you need to be comfortable with that hold period of being in it for 5 to 7 years because you can't exit. There's no secondary market. And in 5 to 7 years, what's nice about these structures is that that real estate will sell, assuming the real estate is, has appreciated. You'll get that on the back end. But now you can go do another 1031 exchange. So for younger investors, you're not going to get in today's market, you're not as likely to get those double-digit returns. It's harder to find deals for the DSTs. But you can see a little bit of growth and you can continue, in 5 to 7 years, you can continue to reinvest and defer those taxes. And that can be quite a saving for investors who are looking to, maybe invest another 20 years, but they don't want to cash out. So yeah, that's kind of like the broader overview of the DST market and who's investing in.
You had given the example of, like a $50 million raise, for a large property in Atlanta or whatever. So just to kind of compare, the stuff that I look for. Now I'm on the smaller end for syndication, so most of our properties are 25, 50 units. We're working on one. We've got two that are over 100. I know there's other syndicators that do, 250, 500 to 1,000 units. So kind of talk about like size wise, the types of properties, location wise. Like if I'm an investor, how do I find these? How do I know that they're reputable
Yep.
versus, buying in Atlanta versus something in Boston, right? And so kind of like what's that due diligence look like for selecting something like that when, my job, so I do 506B, so it's very much personal relationships, people that I know. For these DSTs, I'm guessing you probably don't know the person that's buying the $50 million apartment building in Atlanta. So kind of walk through that due diligence phase and kind of what types of properties or what types of things. I know it can kind of be anything, but yeah, just a little clarity on that.
Yeah, so what's really unique about the DSTs and part of why they qualify is there's what's known as the seven deadly sins that are outlined that really state things that cannot be done with a DST. one of those things is that they cannot go and raise capital. They can't through that hold period. So when they structure the DSTs, they're going to raise some extra capital up front, known as the reserves account, and that account is going to be meant to kind of, help maintain the property through the hold period. Um, that's important to understand because it speaks to the type of assets that you'll usually see within a DST. They are going to generally be, and it doesn't have to be, but like if we're looking at a multifamily property, we're typically going to see relatively new construction in a core market, right? We want a strong metropolitan area where we see migration, where we see people moving, where we see industries moving in. But we want to balance that with, okay, but we don't want to see too much new supply coming online. And so those are the types of markets that you're investing in. They are usually in more of what we would call landlord and tax friendly states, right? I'm here in California. I don't know the last time I saw a DST in California, right? We're not, it's a little bit more challenging. So where a lot of these deals will be like in your Sun Belt states, a little bit in the Midwest today, right? We're seeing more in that Ohio market. Um, we still have, Florida. Florida's kind of picked up. Insurance was an issue for a while, but now Florida's picked up. Texas is pretty soft though. There was so much development through COVID, but you'll see them nationwide. But what we're looking at is not just the state, but what's happening in that market. What's driving the demand for that. And that's on the multifamily. DSTs can also have commercial assets. So it can include a single tenant property that has a corporate guarantee, like a triple net. It can have a portfolio of those. It can include, recently we've seen self-storage has been prominent. Um, Self-storage, I don't know if you've talked too much with the audience about self-storage. Recently, it's had a little bit more challenges than it had
Hmm.
historically. So we've seen a softening in the opportunity in self-storage, but industrial, right? Your industrial properties, as we see manufacturing pick up here in the States, we see those semiconductor facilities coming in. So we're seeing specific assets geared towards that. So what the DSTs incorporate are these assets that are, like I said, usually Class A, core, stronger markets, um, near projects that are going to support it for that 5 to 7 year lifespan. And you really want to stick with the asset classes that have been proven to perform even through economic downturns, right? There are certain
Hmm.
asset classes that senior housing had some struggles through COVID. We all saw what happened, and it has put a hindrance on being able to raise some capital in that industry, in my perspective. But I mean, you can also invest in student housing. A really unique one is, and this isn't a DST structure, but it's in this 1031 realm, oil and gas. You can invest in the subsurface rights in the different basins. And so, and we can speak to that one a little bit too further, but those are the assets that you see. As for, right, how do you find a good deal?
Hmm.
So there are over 50 sponsors. These are both 506C and 506B deals. Um, there's, let's call it 90 deals on the market, give or take, at any given time. And there is no um, guided underwriting on these deals, right? You are investing with sponsors who have done the underwriting. Just like your investors come to you, they're going to look at how you underwrite deals. They're going to look at how you've done. They're going to ask, who are you as a person? So
Hmm.
it's just like investors come to you and do that. It's kind of the same on the sponsor level, right? When we're looking at sponsors, we want to look at sponsors who have been around for a while, who have been through economic cycles and who have come out, not necessarily the deal, like some deals have struggled, but we want to make sure that the sponsors have treated the investors right, that they've put the investors first. And then, so when you look at a DST, I say this to everyone, when you look at any sort of syndication, look at who's sponsoring it first, because at the end of the day, that's who you're investing with. And again, if you want to look at some of the sponsors, you have Um, you know, inland, you have Blue Rock, BlackRock's coming into the space right now. So these are not your mom and pop shops. They have private and publicly traded REITs. They have different interval funds. These are multi-billion dollar companies. And so that's who you want to a lot of times invest with. So that's the number one. Look at the sponsor. We look at the real estate, right? Make sure the metrics of the real estate pan out. Because of the restrictions, you want to have, I would say, more conservative underwriting. And then you want to look at the trust structure. What does that DST trust structure look like for the investor? These are 200 to 300 pages. And this is where working with advisors and professionals is very important because if you haven't looked at one of these before, you're going to open it and you're not going to know where to look. And, thankfully, everyone today runs it through like AI. And they're like, well, and I can tell, I'll get these lists of questions someone will send me. And I'm like, well, you put this through Chat GPT.
I didn't consult my attorney. I just ran it through AI, and
Yeah.
it's a lot cheaper that way.
Yeah. And I'm like, I mean, but they're solid questions. And to me, it's been nice because I think that AI has allowed investors to ask more sophisticated questions and also to look at the risks in the deals and have those conversations. People can put out what they want, but does the data support it? So
Mhm.
I think AI is fun and how it's supported. But that was a long way to tell you about how, these deals go through very thorough due diligence if you're working with the right advisor. Not everyone does that, right? You just want to make sure that you work with someone who is doing that sort of due diligence and making sure that the long-term viability, the exit strategy is all in place and that you're going to get, there's no guarantee, but that we want to do our best to be able to provide that income through a hold period, be able to provide capital preservation and maybe a little bit of appreciation if the
Mhm.
market permits.
Are you looking to get started or scale in real estate investing but don't know your next step? Are you overwhelmed thinking about finding deals, analyzing deals, doing due diligence, and managing properties on top of it? Go ahead and push the easy button and invest with us. Real estate investing is what we do full time. We've done dozens of deals with hundreds of doors. We have the knowledge and experience to handpick the best deals that most investors can't find. We vet large off-market deals all the time where you can hopefully find returns and economies of scale that you just can't find on your own. The best thing is it's 100% passive to you for less capital than you put down trying to acquire a property on your own. Don't let this year go by where you don't make the leap, add to your portfolio, or you just sit in analysis by paralysis. To find out more, visit freedomthroughrealestate.com and click on invest. You can book a call and learn more there. So get to scaling your portfolio now with us by your side. That's freedomthroughrealestate.com and click on invest. And I think, yeah, the key for people to remember is, yeah, there's so many things you can do. And so obviously you help with kind of finding, is this the right time for me, what I'm looking for, and then finding an investment opportunity that matches with that. Because, yeah, like you said, if it's a 5 to 7 year hold, and that's the thing that we tell investors. It's not like if I had my own duplex and I wanted to sell it, I can just call an agent or sell it myself, whatever that looks like, because I need the money. Here, you can't because you don't have
Correct.
an
No.
active share in being able to have those voting rights to say I want to sell. And so that's where things like self-directed IRAs for us has been helpful because it's like, well, if you're not planning on having those funds till retirement, it's not like, hey, this was in my bank account yesterday and now it's not, and I need that money. And so just understanding it's a different place where your money's going and it's not coming back right away.
Exactly. And that's one of the I shared a little bit about myself and my real estate experience. In my opinion, and how I work with investors, and I think that we need more of this in the industry, is working with investors to help them understand what the opportunities are. Probably what your podcast is doing is being able to educate investors on these different avenues so that they can make an educated decision on what's best for their portfolio and their long-term goals. Because I will have investors come to me and we'll have conversations about, we'll look at what their real estate, their existing portfolio, what their basis is, what their goals are for income, what their long-term goals are, what they're planning for their estate. And you need to make sure all of those line up because I wouldn't, I mean, I wouldn't, and I assume others wouldn't want to put a client into an investment where it's not the right fit. It doesn't match those goals. And so what I do with clients is I run through all of that and we talk about our DST is a good option. Really a good comparison in this market is that single tenant triple net property where you buy a dollar store, you buy a QSR, a quick service restaurant, where you own the real estate. You are able to sell it if you want. But the way that the lease structure is, it's these net lease. If you have an absolute triple net property, the tenant is responsible for maintenance, taxes, insurance, and the landlord is collecting that monthly check. And so that's a good avenue for if a client says, "Oh, I want the liquidity, I want, so there's other options that we want to look at to make sure it's a
Mhm.
good fit. For some clients, cashing out. It sounds crazy. People will be like, I'm just going to pay taxes. That's 30-40%. But it's such a broader picture to look at than just this one transaction, right? Um, Maybe they need that liquidity. Maybe that is a smaller portion, so that's something that I do with investors is
Mhm.
that broader assessment to make sure we're going in the right direction. And if the inventory that I have isn't a good fit, that's where, working with referral partners and just having that broader sense of availability in the market. And I wish we saw this more today. We're a very transactional industry across the board in real estate. And I do like to provide more insight and education, which I appreciate because that's what you're doing with the podcast, so that investors can pick the right option. But I will say, most of the time, if an investor has owned real estate for a long time, the 1031 exchange is a great solution
Yep.
because I've never met anyone who was excited to pay taxes. They will pay taxes, but they're not like, oh, actually, I just can't wait to pay this 20% to the government. But they want the liquidity. They want,
Mhm.
and it's fun. We have conversations about what they want to do, and some of them, they just want the cash.
Doing a great job. You're building great long-term relationships with people, and you're taking a much, 30,000 foot view of what do they want to have, what do they want to accomplish, and where is this going to go? Versus sometimes as investors, they think kind of the right now, and so you're able to help them see the bigger picture, see the benefit of the passiveness of the investment, and then obviously the tax savings long term as well, and then helping them long term because yeah, you're right. This is going to be a 5 to 7 year thing, and so you want to put them in the right spot so then either 5 to 7 years later they come back to you, or when they have more money, then they come back to you for other things with other assets that they have that they want to put into DSTs and stuff like that. So definitely relationship business,
Yes.
doing a great job helping people long term, big picture with their money and their real estate assets.
Yeah, and then one thing I'll add, so I primarily work in the DSTs. It's just been the niche that I've fallen into, but in regards to opportunities in the market, the alternative real estate industry is growing, and there are more opportunities for investors to come in and get into a fund that has more of that growth opportunity or that's more geared towards income. And so for the investors who are looking for that growth, that opportunity to build their portfolio, but I it's hard to find a deal today. I admire like you who you're still boots on the ground finding those deals because it is very tough in
I
this
tell people
market.
that we're looking for a needle in a haystack. So,
Yeah.
that's it's what we're looking for. We've got to find that deal that's worth our time to be able to spend on it. So it's not easy. Yeah, it takes time.
Yeah, and so find you don't have to go buy a direct property. There's so much opportunity to get into the real estate market. And I am a huge advocate of that because that is a great way to build wealth, build a portfolio, um, and prepare for retirement. And so whether it be, getting into something, your first deal, or for those who are working with me who are trying to get out, there's ample opportunity, right? I mentioned oil and gas. it's a very unique asset class that qualifies for a 1031 exchange. Most people don't know that you can buy subsurface rights, you can buy air rights, there's all kinds of stuff that you can buy out there.
Hmm.
And just being able to get your foot in the door is just the first step. And then using all these different strategies, using the 1031 exchange to build it, and then using the DSTs to exit, all good opportunities for investors. A lot of investors are looking for that last step. They're tired of real estate. They just want to be 100% passive. And, there's strategies for that. There's what's known as a 721 UPREIT, where you move into a REIT or a real estate investment trust. Um, and that you can get to via a 1031 exchange. So there are so many paths out there, and the DSTs are going to continue to grow, right? Like I mentioned, there's so much wealth being transferred between generations that it is a topic for investors to know, but also what professionals need to start being more mindful of. Because I get a lot of calls from like investors whose maybe agents didn't know about DSTs or 1031 exchanges, and they call me and they're like, I just sold and I have all these taxes that I'm paying. What can I do? Um, they can do OZ funds, which, we can dive in at another day. That's a whole other topic. But it's important for people to understand this exchange process and using DSTs either as a primary or even a backup solution if you can't find another deal.
So much more that we can dig deeper on, and yeah, we could have you on another day and talk about that stuff. Thank you so much, Ashley, for coming on, sharing just a ton of information. Obviously, if people have, much deeper questions, they can reach out to you. So how can people do that if they want to learn more or they want to get a hold of you?
Yeah, so my phone number is the best way, 949-235-5606. You will get me directly. I love to talk about real estate strategies with investors. Company website, GCA1031.com. You can visit there. All my contact information is there as well. And like I said, we work with investors on the real estate exit analysis, helping them understand what their position is and where they should move next.
Well, thank you so much, Ashley, for coming on and sharing. Certainly helping a lot of people out. And for people that are interested, reach out to you. And thank you so much for being on the show.
Thank you, Mike.